There are at least 5 bills the average American over the age of 65 is paying every single year that they are not legally required to pay. 5 bills. And before I go one sentence further, I need to clear up the single biggest misunderstanding about this, because it is the reason most people click away and leave thousands of dollars sitting on the table. People assume a video like this is only for one kind of senior. They think it's only for low-income folks who are struggling to get by. So if they are comfortable, they tune out, or they think it's some advanced, complex wealth trick for millionaires. So if they are living mostly on Social Security, they tune out. Both of those assumptions are completely wrong, and I want to be crystal clear right now. This list is for both of you, whether your entire income is a single Social Security check or you have a pension, a 401k, and a home that has tripled in value. There is real money on this list with your name on it. For some of these bills, the win is biggest for the lower-income retiree. For others, the win is biggest for the comfortable middle-class retiree. I am going to tell you on every single one exactly which group it helps and exactly how to claim it. So nobody watching this can say this is not for me, because the honest truth is that seniors at every single income level are overpaying these bills, just in different ways. The reason almost nobody tells you about these exemptions is brutally simple. Every single person whose job it is to collect that money from you has a direct financial incentive to keep their mouth shut. Your county does not call you on your 65th birthday to tell you they will freeze your property taxes. The Social Security Administration does not send you a letter reminding you to stop. The tax withholding coming out of your check, the tax preparer charging you $300 does not lead with the fact that you legally qualify to have your return done for free. And the biggest one of all, a brand new deduction worth up to $6,000 a year is sitting right there in the tax code, and most of the seniors who qualify for it will never claim a single dollar. In the next 25 minutes, I am going to walk you through all 5 of these bills, one at a time, in plain English. And if you stay to the end, I am going to add 3 bonus wealth moves for the retiree who has built up a nest egg, because those last 3 can be worth an absolute fortune. Here is the one idea that ties this entire video together. Listen to me very carefully. Being legally exempt from a bill and actually not paying it are 2 completely different things. The law does not refund you automatically. Nobody mails you a check because they feel bad. You have to know the rule exists and you have to stand up and claim it. Let's fix your invisible bills right now. Let's start with the one that makes people the most angry once they find out how it works. Bill number 1 is your property tax. I want to be very precise here because this is exactly where seniors at both ends of the wealth spectrum get told they do not qualify, when very often they do. Here is the truth about local governments. There are really 3 kinds of senior property tax relief in America, and between the 3 of them, they cover almost everyone. The first kind is income-based. It's often called a circuit breaker. This one is aimed squarely at lower and fixed income seniors. If your income is modest, this program can knock your property tax down dramatically. In some places, a low-income senior can have a huge share of their home's value exempted entirely, or have the tax deferred until the home is sold. The second kind is a flat senior exemption. This just knocks a chunk of the taxable value off the top of your home, regardless of how much money you make. But the third kind, this is the one comfortable retirees always assume they are too well off for. It is an age-based freeze with 0 income test. Let me give you the clearest example. In the state of Texas, once you turn 65, you get a tax ceiling that freezes your school property taxes at the exact level you paid the year you turned 65. Your home value could double over the next 10 years. Your frozen tax bill does not go up a single dime, and there is no income limit on that freeze. It does not matter how comfortable you are, whether you make $40,000 or $400,000 a year. You qualify because of your age, period, and Texas is far from the only state with a freeze or a cap like that. Look at how this system covers both groups. The lower-income senior gets the circuit breaker relief that can wipe out most of the bill. The comfortable senior who is shut out of the income-based program still gets the age-based exemption or the freeze that the wealthier homeowner just assumed wasn't for them. But here is the catch that costs everyone. Here is why the system is rigged. None of these are automatic. Your county assessor does not look at your date of birth, see that you just turned 65, and automatically apply the discount to your next bill. You have to file for it, and almost every one of these programs has a hard, strict deadline, often early in the year. If you miss that deadline, you pay the full maximum bill for that year, and you have to wait an entire 12 months to try again. Why would your county not chase you down to help you claim it? Because every dollar of relief you claim is a dollar of revenue they lose. Their budget depends on you not knowing the rules. Here is your action step for bill number 1. You make one phone call. You call your county tax assessor, or you go to their website and search the words senior exemption and freeze. You ask them 2 questions. What relief do you have for homeowners over 65? And which of your programs are based on age with no income limit? That single 10-minute phone call has been worth hundreds and often thousands of dollars a year to people at every income level. Stop paying the county money you don't owe. Bill number 2 is your federal income tax, and I need you to really hear this because for millions of seniors, the correct amount of federal income tax you owe going forward is far lower than what you are currently paying, and for a great many of you, it is exactly 0. Yet many of you are still paying it or still having it withheld from your checks out of pure habit and fear. Here is what just changed. There is a new law on the books, and buried deep inside it is something called the Senior Bonus Deduction. This starts with the 2025 tax year, the taxes you file in early 2026. Every single person who is 65 or older gets an extra deduction of up to $6,000. If you are married and both of you are 65 or older, that is $12,000. Here is the part that makes this so incredibly powerful, that $6,000 stacks on top of everything else you already get. It's on top of your regular standard deduction. It's on top of the extra standard deduction seniors have always gotten for being over 65. You do not have to itemize your taxes to claim it. You do not have to give anything up to get it. It is simply added on. So who does this help? Once again, it is both groups. If you are a lower income senior living mostly on Social Security, stacking these deductions together very likely pushes your federal income tax liability all the way to absolute 0. It may mean you do not even need to file a tax return at all. But if you are a comfortable middle-class retiree, you are not left out either, because this deduction is available in full to single seniors with income up to $75,000 and to married couples with income up to $150,000. It only begins to shrink above those numbers, and it does not fully vanish until you are making over $175,000 single or $250,000 married. The only people this truly leaves out are the genuinely highly wealthy. Everyone else, from the retiree on a modest fixed income to the couple living on $100,000 a year, gets real, life-changing money here. But there is one more thing you must know about this because it makes it urgent. This rule is temporary. As the law stands today, the senior bonus deduction is only here for 2025, 2026, 2027, and 2028. It is a 4-year window unless Congress extends it. This is a claim it now, every single year while it exists situation. If you use tax software, make sure it asks your age and properly applies this new baseline. If you pay a professional to prepare your return, you sit down in their office and you make sure they applied the 2025 senior bonus deduction. Do not pay the IRS federal income tax you do not legally owe. That leads us straight into bill number 3, because it is the other half of the exact same coin. Bill number 3 is the tax on your Social Security benefits. Now, a lot of people believe Social Security is always taxed. A lot of other people believe it is never taxed. Both of them are wrong. Here is the actual mathematical rule. Whether your Social Security is taxed depends on a calculation the IRS calls your provisional income. Provisional income is basically all your other income plus exactly half of your Social Security benefits. There is a lower line and an upper line. If you are single and your provisional income comes in under $25,000, or you are married and it comes in under $3,200, then 0% of your Social Security is taxable. None of it. As your income climbs above those lines, more of the benefit can be taxed, up to a maximum of 85% for higher income retirees. Which means by law, even at the very top income brackets, 15% of your Social Security is always tax-free. So here is the win for each group. If you are a lower income senior, there is a very good chance the correct tax on your Social Security is 0, and that new senior deduction we just talked about makes that even more likely. If you are a comfortable retiree with more income, I am not going to insult you by pretending the tax completely disappears. But the new deduction can absolutely drop the taxable portion down to a lower tier. But here is the massive mistake that hits everyone, rich or poor. The W for V trap. When people file for Social Security, a great many of them check a box or fill out a form called the W for V. This form tells the government to voluntarily withhold federal tax from every single monthly Social Security check just to be safe. They are terrified of owing the IRS at the end of the year, so they just let the government take a chunk out of every check. Then a big chunk of that money comes back to them as a refund the next year, if they even remember to file a tax return at all. Think about what you are actually doing there. You are letting the federal government hold your money with 0% interest all year long on a tax you may not even owe, or you are having them hold far more than you actually owe. That is your money. That is money you could use for groceries, gas, or a high-yield savings account. The fix is simple. You look at your real numbers, you calculate your provisional income, and you file a new W for V form to right-size or completely stop that withholding so it matches what you will actually owe and not $1 more. Whether you owe nothing or you owe a little, the goal is exactly the same: pay what you owe on time and not 1 cent early as a free gift to the United States Treasury. Bill number 4 is your Medicare premiums. There are actually 2 completely separate overpayments hiding here. Conveniently, one helps everybody and the other helps the higher income retiree. The first one is simple and it applies to everyone. Medicare Part A. This is the part that covers hospital stays. Part A is supposed to cost you $0 in premiums if you or your spouse worked and paid into the system for at least 10 years, which they calculate as 40 quarters. The vast majority of Americans have done exactly that. Yet every year people pay a premium they never needed to pay because of confusion or a clerical error about their work record. If you are paying for Part A, that is worth a hard second look no matter what you earn. But the second overpayment, this is the monster. This one is aimed right at the comfortable retiree, and it has a name that sounds like a person. It is called IRMAA. IRMAA stands for the Income-Related Monthly Adjustment Amount. It is a massive surcharge the government piles on top of your Medicare Part B and Part D premiums once your income crosses certain thresholds. By definition, this only hits people who have a solid income. But here is the trap inside the trap. Pay attention to this because it catches millions of new retirees off guard. The income the government uses to calculate your IRMAA surcharge is not this year's income. They base it on your tax return from 2 years ago. Picture this. You are 64 years old, you are still working, you have a great salary, maybe you sold some stock, you had a great earning year. Then you turn 65 and you retire. Your income immediately falls off a cliff because you stopped working. But 2 years later, Medicare looks back at that old, high-income tax return from when you were 64 and they hit you with a massive monthly surcharge based on money you are no longer earning. People just pay it. They see it show up as a quiet deduction taken straight out of their Social Security check, and they assume the government must be correct. It is not correct, and there is a form to fix it. It is called the ESSA 44. The government has a list of what they call life-changing events. If you experience one of these events, you are legally allowed to appeal the IRMAA surcharge, and guess what is specifically written on that list? Retirement, work reduction, death of a spouse, divorce, loss of pension. If your income has fallen because you retired, you file for MESA 44. You show them that your income has dropped, and they are legally required to recalculate your premium based on your real current, lower income, not the ghost of your past salary. I have seen that single form put thousands of dollars a year back in a retiree's pocket. Almost nobody files it because almost nobody knows it exists. Bill number 5 is the one that is going to feel almost personal because it is the fee you pay just to deal with all the others. Bill number 5 is your tax preparation fee. Every single year, millions of seniors walk into a brightly lit storefront tax office or a big-name chain and hand over somewhere between $300 and $500 to have a fairly simple retirement tax return prepared. and many of those people legally qualify to have that exact same return prepared for free by people the Internal Revenue Service itself has trained and certified. There is a free program built specifically for seniors. It is called TC Tax Counseling for the Elderly. This is an Internal Revenue Service program for people 60 and older, and the people who run it specialize in exactly the questions retirees have: pensions, Social Security, and retirement account withdrawals. The largest provider of this program is AARP TaxAid. They run thousands of sites across the country, usually in libraries and community centers, and you do not even have to be an AARP member to use it. Its focus is on older adults of modest to moderate means. That phrase matters. It is not just for the lowest incomes, it covers the broad middle class too, and on top of that, the government now has its own free online filing options for people comfortable doing it themselves. Now look, I am an enrolled agent. They run thousands of sites across the country, usually in libraries and community centers, and you do not even have to be an AARP member to use it. Its focus is on older adults of modest to moderate means. That phrase matters. It is not just for the lowest incomes, it covers the broad middle class too, and on top of that, the government now has its own free online filing options for people comfortable doing it themselves. Now look, I am an enrolled agent. I represent taxpayers in front of the IRS for a living, so there is a part of me that is talking myself out of business by telling you this, but a person with a standard retirement return to Social Security checks, a pension, and maybe a few regular investment statements should never assume they have to hand a retail chain $400 for 45 minutes of data entry. Here is the honest line though, and it applies to everyone. If your situation is genuinely complicated, if you have a business sale, complex rental properties, or a massive estate, then yes, absolutely pay a real professional. A good CPA or enrolled agent is worth every penny in those situations. But if your return is straightforward, the law has already built you a free qualified option. Using it is not cheap, it is smart. Now I promised you 3 bonus moves before we finish, and I want to be straight about who these are for. The 5 bills we just covered reach across every single income level. These last 3 are specifically for the comfortable retiree, the person who has built up some money, a home that has appreciated, a taxable investment account, or a healthy IRA. If that is not you, do not feel left out. The first 5 already had you covered, but if you have built up a nest egg, these 3 moves can be worth more than everything else combined. The low-income focused videos never mention them, but you need to know them. Bonus move number 1. The home sale exclusion. Here is the fear that lives in the heads of so many older Americans. You bought your house decades ago for $60,000. Today it is worth $400,000, and you are terrified that if you sell it, the government is going to completely gut you on taxes for that enormous gain. So you don't downsize. You stay in a house that is too big, too hard to clean, and too expensive to maintain because you are afraid of a tax bill. In most cases, that tax bill does not exist. There is a rule called the home sale exclusion. If you have lived in your home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of gain from federal taxes if you are single. If you are married filing jointly, you can exclude up to $500,000 of gain. Gain is not the sale price. Gain is what you sold it for, minus what you paid, minus the improvements you put in. So that couple whose home went from $60,000 to $400,000, their gain is $340,000. Because they are married, they can exclude up to $500,000. Their federal tax on that massive home sale is exactly 0. They were sitting in a house they no longer wanted, scared of a tax that was never going to hit them. Bonus move number 2, the 0% capital gains bracket. This is one of the best-kept secrets in the entire tax code for retirees who hold stocks or mutual funds outside of a retirement account. When your taxable income is low enough, the federal tax rate on your long-term capital gains is not 15% and it is not 20%, it is 0. For 2025, a married couple can have taxable income up to roughly $96,700 and still pay 0% on their long-term gains. And remember, that is taxable income, which is your income after your standard deduction and that new senior bonus deduction come out. A couple bringing in well over $100,000 total can still drop into the 0% zone, sell appreciated investments, and not pay a single dime of federal tax on the profit. Retirees are in the perfect spot to use this. In the years after you stop working, but before the government forces you to take massive required withdrawals. From your 401k, your income is often at its lowest point. A smart retiree harvests their stock gains in those low-income years on purpose, pulling money out completely, tax-free, instead of letting it pile up to be taxed later. Bonus move number 3, the Qualified Charitable Distribution (QCC). This is for anyone 70 and a half or older who gives to charity even a little and has money in a traditional IRA. Most retirees today take the standard deduction. That means when you put money in the offering plate at church or donate to a charity, you get absolutely zero tax benefit for it because you aren't itemizing. The QCC fixes that. Once you turn 70 and a half, you can have money sent directly from your IRA to a qualified charity. It never touches your bank account because it goes straight to the charity. That money is completely excluded from your taxable income. It never shows up on your tax return. This is infinitely better than a standard deduction because it keeps your overall income number artificially low. And what did we just learn? If your income stays low, your Social Security isn't taxed, and your Medicare IRMAA surcharges don't get triggered. Plus, QCC counts toward your required minimum distributions. So instead of being forced to pull money out of your IRA, pay tax on it, and then donate what's left, you send it straight to the charity, satisfy the government's withdrawal rule, and pay no tax on any of it. Let me tie all of this together with the one idea that matters more than any single rule I just gave you. In every single one of these cases, the law already says you are exempt. The law says you qualify. The law says you do not owe the money. The senior bonus deduction is in the code. The property tax relief is on the books in your own county. The Medicare appeal form is sitting publicly on the government's website. The 0% capital gains bracket is real, but not a single one of them is automatic. The government does not refund you for a rule you did not claim. No one mails you a check for the deduction you forgot to take. The entire system is built so the money stays right where it is in their pockets unless you stand up and claim it. Being legally exempt is worthless until you actually act on it. The people who collect these bills are counting on one thing: they aren't assuming you are dishonest. They are assuming you think this relief is for someone else. The struggling senior assumes the good stuff is for the wealthy. The wealthy senior assumes the relief is only for people who are struggling. So both of them just keep paying. That is the entire game. Knowing the rule and knowing it applies to you is the whole thing. You now know the 5 bills, you know the 3 bonus moves, but knowing is not enough. You have to act. Do me one final favor. Send this video right now to one person in your life who is over 65 or getting close. Send it to a parent, a neighbor, or a friend from church. It does not matter if they are getting by on a single check or sitting on a paid-off house. The odds are extremely high that they are paying at least one of these bills right now for absolutely no reason. One text message, one share from you could be worth more to them than any gift you will ever give them. Hit the like button so the algorithm knows to show this to more retirees who desperately need to hear it. Subscribe to the channel, stop paying bills you don't owe, and I will see you in the next one.